It is now my pleasure to introduce Peter Routledge, who was appointed Superintendent of OSFI in June 2021. Prior to that, he served as CEO of CDIC with senior roles at the Department of Finance and in the financial services industry, both in Canada and abroad. Monsieur Routledge a été nommé au poste du surintendant du BICEF en juin 2021. Avant, il a occupé le poste de président-directeur général de la Société d'assurance de dépôt du Canada. Il a assumé plusieurs fonctions de haut niveau du ministère des Finances et a travaillé dans le secteur des services financiers, tant qu'au Canada et à l'étranger. Today, he'll outline a refreshed regulatory approach, touching on how OSFI plans to reduce regulatory burden, strengthen AML, assess U.S. deregulatory pressures, update capital adequacy requirements, advance enterprise-wide model risk management, and support a sound housing finance system. After the superintendent's remarks, Sonia will join him on stage for a Q&A. As you listen to the superintendent, if a question comes to mind, please go into the CVent under Building Systemic Resilience in a Volatile World and submit your question. And we'll get to as many as we can. Superintendent, the floor is yours. Welcome.
Okay, thanks very much for the kind introduction. Sonia, great to be here. Great to see so many interested colleagues to talk about our risk environment. Maybe I'll start with just a shout out for the GRI. Someone just let me know it's my 5th consecutive as superintendent. It won't be my last. The GRI, as you know, started in 2011 as a private-public partnership. And there's some things about GRI I just want to call out and compliment. It's a great example of federal and provincial government cooperation and coordination. Ontario and Canadian governments came together. It's also a great example of public-private partnerships. The industry, financial sector industry, is a very important partner in the GRI, and that's producing balanced, really important leading-edge research that we rely on at OSFI, and we rely on it so much that we volunteer all the time to do work with the GRI. We've done work with them on artificial intelligence, on climate, and we'll continue to borrow from their expertise wherever and whenever we can. So for that, Sonia, thank you. There's an old saying that there are decades when nothing happens and weeks where decades happen. And the present day resembles the latter part of that framework, I think. The year 2025 has reminded me of the period dating between 1989 and 1991, where it seemed every day when I walked past the newspaper box, remember those? They're not around anymore. But every day I walked by the newspaper box, I'd see a headline that just blew me away. It was amazing. Well, and that occurred as the world was living through the end of the Cold War. The current era is no less bracing than that time. From escalating geopolitical instability and cyber threats to climate change, from domestic economic shifts to technological innovation, the risks and opportunities facing Canadian financial institutions are complex and consequential. Just like our country, Canada's financial system is navigating through a period of profound uncertainty. Now, one can confront this uncertainty with trepidation, with fear, optimism, or a mix of all those. With humility towards the uncertainty that is always present, with this talk, I'd like to emphasize optimism. Over the last 15 years, the boards of OSFI's regulated constituents have built enduring resilience into the Canadian financial system. With encouraging support from their friendly financial institution supervisor. Their efforts have proven both necessary and effective. And we are grateful for the boards in this industry. For example, Canada's systemically important banks reported capital ratios, or for technical people, common equity tier 1 ratios, that averaged 13.7% in the most recent quarter. That is 220 basis points above the floor for a well-capitalized, systemically important bank. One way to think about that is that the denominator of that capital ratio, or the CET1 ratio, which we know as risk-weighted assets, could rise by approximately $500 billion before that ratio fell to 11.5%. In layperson's terms, banks could make nearly $1 trillion in additional loans or other extensions of credit and remain above current capital minimums. This is a material amount and a material figure relative to Canada's $3 trillion economy. Here is a reason for optimism. Canada's banks have ample capacity to help fund the country's adjustment in this new era. Elsewhere, Canadian life insurers have boosted their core capital ratios by approximately 13% over the past 6 years, and they themselves maintain ample capital buffers that can be similarly leveraged for new investments in the Canadian economy. Since the global financial crisis, OSFI has also implemented requirements for financial institutions' liquidity and for protections against integrity and security risks. On the basis of this evidence, I am confident that the Canadian financial system is as resilient as it has ever been. Unusual, certainly, for a financial institution supervisor to declare something like that. I do refer again to the humility I have about the uncertainty we face. Resilience is not a guarantee. It is an asset, and one that is finite at that. But I do believe Canada's financial system is in a strong position to help the economy adapt to our new economic environment, or put differently, to help the financial institutions we regulate help the economy to adapt to our new economic environment. Indeed, we see the system's resilience as a strategic advantage to be leveraged to support Canadian businesses and households as the country adapts. When banks, insurers, and pension plans are well regulated, adaptable, and capable in managing their risks, Canadians benefit from reliable access to credit and financial services to stronger support for businesses and communities. At OSFI, we believe a resilient financial system isn't just a safeguard, it's a catalyst for national prosperity. So what can OSFI do now to help Canada's federally regulated financial institutions help the country and the economy adapt? We'll be answering that question over the next several years, and I suspect the answer will change as the environment changes. But let me give you 3 overarching answers to that question right now. First, we'll be proactive. Second, we'll look for opportunities to support competitive balance. And third, we'll look for opportunities to support innovation and ease the burdens of entry into the system that we regulate. So let's talk about the first one. We'll be proactive. Driven by events outside our control, we at OSFI have adapted a guiding principle: always be advancing. This compels us to act early, think strategically, and remain outcome-focused in this new era of uncertainty. We continue to modernize our regulatory approach to be more agile, transparent, and risk-intelligent, eliminating outdated guidance, adjusting regulatory intensity, and pausing select initiatives based on continuous industry engagement and a commitment to a smart, effective form of oversight. For example, in 2024, we rescinded 20 guidelines and industry advisories. There will be more to come on that this November. Earlier this year, we paused increases in the Basel III output floor to ensure that competitive balance prevails for Canadian banks that compete in the international banking system. In July of 2025, a few months ago, we announced a reduction in capital requirements for Canadian infrastructure, debt, and equity investments made by OSFI-regulated insurers. We plan on announcing more proactive regulatory initiatives to help our regulated constituents help the country. We'll be looking at relative risk weightings for banks, and we'll consult with industry constituents and public sector partners on the capital treatment of certain types of loans to encourage business lending by banks in support of the economy. Let's go to number 2, looking for opportunities to support competitive balance. As I mentioned a minute ago, we did pause our implementation of Basel III, pause only, to help our internationally active banks compete more effectively against global peers. In OSFI's mandate, Parliament instructs OSFI to have due regard to the need to allow financial institutions to compete effectively and take reasonable risks. In our view, an OSFI that follows Parliament's instructions is an OSFI that respects competition and competitive balance. Competitive balance does not start at the water's edge. It's a grassroots concern. To support competitive balance domestically, we have a number of initiatives on the go. Earlier this year, we engaged with small and medium-sized lenders about changes to capital requirements that will enable them to compete more effectively while ensuring their risk-taking remains reasonable. We also continue to engage with smaller institutions about how we could reduce some regulatory burden so that management teams have more time and resources to face the uncertainty ahead. Again, you will hear more from us on this in November. Our third answer to that question, what can OSFI do to help? We'll look for opportunities to support innovation and ease burdens for entry. New entrants can give financial institution regulators a little heartburn. The problem is that some new entrants succeed while others fail. This is the nature of competitive capitalism. And financial institution regulators, public servants have varying degrees of tolerance for failure, for institutional failure. Since 1996, Canada has not had a deposit-taking institution fail, at least a federally regulated deposit institution. In the same time, the US banking system absorbed over 500 failures of deposit-taking institutions. Meanwhile, the Global Failed Insurer Catalog, produced by Canada's PASIC, the Property and Casualty Insurance Compensation Corporation, lists just 7 insurer failures in Canada since 2000. Not all of those were OSFI supervised, amongst a catalog of 547 insurer failures. Given these statistics, I think it's reasonable to conclude that OSFI could adjust its risk appetite with regards to new entrants. At OSFI, we will revamp our approvals process to ease entry, and with that, mature our tolerance for risk. We aim to find opportunities for more timely approval of new entrants to the banking sector. Given the extraordinary innovation in financial services, particularly digital money innovations like stablecoins and tokenized deposits, the time is right to look at streamlining our approach to approvals and our process for approvals. In addition, we will continue to look for opportunities to stay out of the way of innovators already in our system as they develop new products based on distributed ledgers or other expanding technologies. When our regulated constituents bring OSFI ideas and request either support or non-disapproval, our first instinct will be to avoid impeding innovation. Obviously, innovation and new entrants bring risk, and other financial systems experiences provide us a warning against over-aggressiveness. To guide us, OSFI will reinforce our simple regulatory principle for innovation. Same activity, same risk, same regulatory principles. So in closing, with an unwavering focus on a resilient financial system, innovation, and public confidence, we will enable Canadian financial institutions to play a central role in reinforcing Canada's economic strength in this era of great uncertainty. Thanks very much, Sonia, and let's get down to business.
Thank you.
Far one.
So thank you very much, Peter, for the kind words at the beginning. I will note that this may be the first time we've had a room this full at this time of the day. So I'll also note that this is the most optimism we have had for the entire day.
Okay.
And I think it's kind of ironic that we have to wait for the regulator to arrive to bring optimism to the room. So I am, as the head of the Global Risk Institute, I'm going to try to beat that back just a little bit, if I can. And so I want to try to understand so we've spent the whole 2/3 of this day talking about the sky is falling. Geopolitical, AI, climate, uncertainty after uncertainty after uncertainty, the US situation. I've had risk officers all lined up here saying they're not sure how they're going to solve all their problems. Probably best that you not have heard that directly from them. And then you come in and say, you have optimism, and we're in great shape, and so let's ease up a little bit and support innovation, et cetera. Now, I know that some of my colleagues here might want to throw eggs at me for trying to push back on you a little bit, but help me understand that a little bit better.
I mean, we went through the financial system, and we went through that with, I think, on a relative basis, pretty good success as a country, as a financial system. I don't think I'm making news with that statement. And yet, there were some pretty massive events that caused us to look inward, and we decided to not only go along with, but to fuel the global movement to bring up the level of resiliency, both in the global financial system and then closer to home. And we have been well out front of other countries in building that resiliency up. We are, but for one element of the Basel III 2017 reforms, fully implemented on Basel III. There's a couple other countries belonging to our very small exclusive club, but basically that club is very small. We have resilience in our system that is not fully present in other systems. And we generally had, and I refer to this in my speech, I mean, we've had boards of directors and senior managers basically accept the premise that a little extra resilience will go a long way towards navigating through the ups and downs of a global economy and a local economy. So my optimism just comes from everything we've built. I'm not negating, in fact, the humility part of what I was trying to say is, yeah, there are some very consequential things happening in the world of geopolitics, in the world of technology, and that's echoing and reverberating into the financial system. But I wouldn't trade my job for any other financial institution regulator in the globe. This is, we may face enormous challenges. We face enormous challenges from a high ground.
So we're not as bad as everyone else. But
I wouldn't put it that way. I'd put it, I have a high degree of optimism and confidence in our resilience, checked or balanced by humility that there are very, very consequential risks, and our resilience is finite. And so this isn't, open up the floodgates and let everything go, but it is, I think we need a concerted effort to ask ourselves how this resilience we have can be leveraged to support whatever changes need to occur in Canada.
So I'm going to finish playing devil's advocate on that one, and we're going to move on now. Something that comes up a lot here and in other markets is the uneven playing field. Not all participants are regulated. And that comes in many forms. It comes in new entrants that aren't regulated at all. It comes in different regulations for different participants. How are you feeling about that right now? And from two perspectives, Peter. One, just if we feel the way that we do about the regulated financial system in terms of their ability to innovate and do the things that they're doing, should we not sort of give them, greater support from that perspective? And two, what about the weak links that aren't part of the regulated system?
I mean, history teaches that rapid innovation in financial systems outside protections or regulations can really lead to unwanted and unexpected increase in uncertainty and risk volatility and cost. And so, you know, since the financial crisis, we have constructed greater protections in the regulated system. From where I sit, and as I look at OSFI over the last 15 years, unintentionally, we've made, you know, we've built up the protection barriers pretty high, or protection walls pretty high. And maybe we can tolerate a bit more risk in the system by making it easier for new entrants to come in. You know, maybe overall systemic risk in the long run will be a little bit more favorable if it's easier for new entrants to choose to come into the regulated system and compete, as opposed to try and develop models that operate outside the boundaries of the regulated system. And certainly, we'd like financial institutions to choose to come into our system, but I think if that's what we want, then there's a burden of responsibility to ease that path. And a lot of what I said about revamping our approvals process is you know, the thought behind that is we have a responsibility to make it easier. And although that may mean our supervisors will have to accept more complexity, a little bit more complexity and a little bit more risk in their supervisory purview, systemically that may be good for this system.
Great, thank you. So I have two questions that have come in from participants that I guess build on that theme. One is, how concerned are you about U.S. efforts to allow their banks to enter the Canadian FI space? And the other is, what is the plan in terms of credit unions becoming more others that are not federally regulated? And so I guess those are two two streams of entrance into the federally regulated system.
I mean, on the case of the U.S. Competitors who want to come in, they're very welcome to come in. I think roughly 16 or 17 U.S. banks operate in Canada today. I'm glad they're here competing. We do have a regime for bank mergers and acquisitions that applies to everyone, every institution, regardless of home office headquarters. And it's a policy choice made by successive Canadian governments really for the last 60 years. And we follow those policy choices. And if the federal government decides to change that policy choice, we will adapt accordingly. We can supervise and be effective in any ownership regime. Two, on credit unions, yeah, the couple things I would say. There is now a pathway to federal continuance. So a provincially regulated credit union, if their members / shareholders decide, they can enter into the federal system and then compete federally, which means across provincial borders. And they can choose to stay within their provincial system and be regulated provincially, but then their borders would be delimited, at least for now, by the province. Our job is not to be in business development. Our job is to pave the pathway to federal continuance. So if members choose, it's relatively smooth and straightforward. I think if you ask some of our current regulated federal credit unions, they would say it took a little longer than they had hoped. I would say in response, yeah, we own some of that timeline, and then the governance process associated with doing that is another part of it. You remember your members, your customers are also your shareholders, and to generate consent for that kind of move, it does take some time. And then on the OSFI side, we've certainly been risk sensitive to bring in large financial institutions with larger balance sheets and assuming the credit and other risks that go along with that. But if I were being fair, I would say both sides have a point that process could be shortened and more smooth.
Good, thank you. This is an interesting question. It's a multiple choice question for you, Peter. It's the first time I've had a multiple choice question. Which of the following is most important to building systemic resilience in a volatile world? I think it's a leading multiple choice question. Interac e-transfer, a government-owned real-time payment rail, stable coins, all or some of the above?
I mean, from our perspective, our mindset should be all of the above. Our mindset should be technology neutral. If the various payment systems are reasonably run, reasonably governed, have protections in place, if it's key financial market infrastructure, it's resolution authority is the bank, and we'd want that authority to be very comfortable with it. But in terms of supervising either those institutions or the institutions that use those services, we should be technology neutral and make sure that we can supervise whatever that choice is. Some of that list are soon to be in place innovations, and some of that list are innovations yet to really be formulated. We have to be ready for all of them, and we probably have to realize they're coming at us pretty quick. OSFI should not be a speed bump on that process. We should be an enabler.
Yeah. How much is what's going on in the U.S. in terms of stablecoin and other moves, you know, the Genius Act and et cetera, impacting how you think about these things in Canada?
Well, I refer to it, it'll speed up on you, the regulatory framework that the United States has built through the bipartisan supported Genius Act. And keep that in mind. You know, you read a lot about all the political debate that goes on in the United States. This act had bipartisan support. And it will enable some significant innovation, we think, in the United States around the product of stablecoin. And I also think it'll also kick off a period of innovation with respect to tokenized deposits. So a deposit that is on the bank's ledger as well as on a distributed ledger. And there's a lot of technology risks to manage with that, but that innovation seems to me to be coming. And so we at OSFI have to get ready for both. And as I said in my speech, our job is to make sure we're not standing in the way of it. And that we are within the bounds of being risk intelligent. We ought not to be impediments to that innovation in our system. Because I do think a Canada that falls behind in financial sector innovation will be a Canada that has a bit more challenges, both in the financial system and the broader economy. And the good news is, the institutions that we supervise get it. A lot of them have operations in the United States, so it's quite important and in their immediate line of sight. And I think you'll see our system adapt to that innovation, and we'll be ready to make sure that we can supervise it in a responsible way.
And so in a responsible way, that's an important addition. How do we avoid the urge to just want to keep up, whether we are ready, prepared, et cetera, both within our financial institutions and in our regulation? Because I'm not, there may be other markets that push forward on things. We've seen it in the past when they're not ready, and there are consequences to that. Eventually, it looks good for a while, and then there are consequences down the road.
So what we need to do is look at how other institutions are looking at these innovations and regulated them and decide what would work in our system. So for example, one part of the Genius Act that I found pretty interesting is that they're, in legislation laying out some prudential standards on the assets that need to match the liabilities that are stablecoins. I thought that was a pretty innovative and cool form of building in safety for that particular product. There may be other parts where we want to do it a little differently based on what our system is. But we should be very quickly putting together a readiness to provide those protections to the system in the event we have players that want to compete on that new innovation or that new product.
You commented in your remarks about no bank failures in Canada for many years. Is the position that you're taking today, is it appropriate to have a follow-on that we would not be uncomfortable with bank failures? Not suggesting that we would like bank failures, but
we think bank failures should be rare and inexpensive. Right? That's a pretty good guidance.
that seems like an optimistic ask.
Right? What we've seen through recent and longer than recent history is it's often a bigger event than supervisors or regulators would like. Right? Now, 2023 was bracing, jarring. And I would be disingenuous if I didn't say, well, the fact that our system navigated through that period of uncertainty relatively unscathed was great relief to me. When there are institutions that fail in Canada, our job is to make sure that they're inexpensive and orderly at going into the failure, which is where we are, right? We're before the point of failure. And then hand off to our resolution authorities in banking or deposit-taking institution case, it'd be CDIC, so that they can promptly and relatively uneventfully deal with, in an unabrupt way, deal with making sure depositors have their claims fulfilled and shareholders get what is left over. And I think if and when we have that experience, I think, and I have a high degree of confidence that as sensational as it will seem at the time, and it will, because it'll be the first thing that happened in X years, the system will come through it okay. We'll take a punch, and we'll adapt, and we'll keep moving forward. It won't feel that way in the Monday where the thing is announced. It'll feel like, oh my God, this is the first time this has happened since 1996. But the system will take that punch and it'll adapt and move forward. And the lesson learned 3 or 6 months later will be, yeah, Canadian system is resilient enough to absorb an institution or institutions that fail.
So maybe 2 follow-ups to that. Would it be fair to say then with new business models that if they fail, we might hit a quicker exit? Like, is that a reasonable thing to assume? We have this innovation, we try something new, it doesn't work, we have a business model that has not proven out, we hit the exit faster.
Well, that'll be the primary actor in that situation are the shareholders and the board and the senior managers of that particular innovation. If that is to happen, OSFI needs to be prepared to, if that's what the wishes of the shareholders and the board are, then OSFI needs to be prepared to enable that, not stand in its way. But I don't, we are not the economic agents in the banking system. The economic agents in the banking system are the owners of the banks. We try and set basic principles and standards so that as they make their own choices, we're in a shared system. The system overall is healthy and safe and capable of absorbing the loss that might come from an institution failure. But I think we want to be mindful of the importance of the autonomy and independence of banks and their shareholders.
Great, thank you. Question on the excess capital in the system. And the question is there a new risk appetite for OSFI, or is the system merely operating well below your risk appetite?
That's a good question. I don't like the word excess capital. There's a resilient level of capital. Is it excess, i.e. more than you need? I think that's a pretty bold statement in the face of the uncertainty we have. And so a good supervisor should not think of the capital in the system as excess or unneeded. I think what I'm trying to say is that given the resilience in the system, given where we are in the economy, as we can begin to think of that resilience as something to be leveraged to enable the economy to navigate through a period of uncertainty. If you want to call that excess capital because it's just a more convenient, simple term, okay. I don't choose to use that word. I have too much humility before the uncertainty. Now, a reasonable critique, well, you're saying one thing, we're going to leverage the resilience. That means there's enough you can let go of it, and there is excess capital. Okay, I admit there is an inherent conflict in the two ideas I'm trying to present. I think for a financial institution supervisor, it is a little arrogant to think there's excess capital. I think an optimistic financial institution supervisor can see the resilience we've built up and see that resilience as maybe an opportunity to provide a little bit of grace so that the financial sector can help the economy make an adjustment to a very, very uncertain period of where I think the country's economic model is going to shift in a fairly consequential way.
Thank you. Integrity and security.
Mm-hmm.
We've heard a lot about that. There's an increase in the OSFI mandate. How do you feel that's going, and how do you think? Like we're getting messages from the U.S. that they don't think we're doing. I mean, they don't use that language, but that they don't think we're doing very well. Yeah. I don't know how they conclude that, but how do you think we're doing?
So, in 2023, the government changed OSFI's mandate in a fairly, what we at OSFI came to see is fairly significant. Traditionally, our mandate was make sure banks are in sound financial condition, make sure insurance companies are in sound financial condition, same for regulated federal pension plans. And there's some subsidiary, take a look at systemic risk, make sure you're acting early, all that. The government in 2023 added a component to our mandate that said, make sure that financial institutions have protections in place against threats to their integrity and security, including foreign interference. And that was, bluntly put, a very significant change to our mandate, and one that was, at least so far as we understood, fairly unique in banking. But in my judgment and in hindsight, I do think that was fairly prescient. Particularly, and I think they really wrote the legislation in 2023, and now look at where we are just 2 years later in terms of our geopolitical environment. So we took that and we defined what integrity and security was. We put it in our integrity and security guideline, and then we built up a group that we call our Integrity and National Security Unit, and it's about 50 people, give or take, and their job is to plug into primarily national partners in the federal government, in law enforcement, national security, anti-money laundering, and start to bring in intelligence that at a particular threshold of materiality then we can supervise towards. And that activity, that process we're building, at least as far as I've been able to determine in my discussions with peers, is unique. And I think in a few years, when we pave the road of information flow from unique, newer partners into the supervisory function, you're going to see something that is unique and important and an additional protection in our system that may or may not be present in other systems. And I think we'll be able to demonstrate that capability with pride. The team that has joined OSFI and is building this capability, some of the brightest public servants I've ever worked with. And it's been fun to watch them build it. It's hard because to go from information that is either national security related or privacy related and find a way to process that in a way that respects all the laws around protection of information, and then turn that processing into supervisory responses. That's tricky, and we haven't fully matured that yet. But we've had some good early cases, and we do think it makes a difference in terms of the integrity and security of the system. And give us a couple years, and then I think we'll have a story that we can tell with pride.
Great, thank you. We haven't used the word proportionality yet. GRI has grown its membership quite significantly over the last few years, and that's been primarily through small and medium-sized businesses. And I'm sure I'm not telling you something you haven't heard endlessly, that they feel that maybe the regulator and they don't see proportionality quite the same way. As you think about what you're describing today in terms of, I know you didn't use the word flexibility, but I'll use the word maybe a little bit more flexibility and considering innovation and growth, how does small and medium-sized business fit into that?
Small, medium-sized financial.
Yes, sorry, financial institutions. Apologies.
I do think they have a case to make that is credible. I do think we at OSFI
I can't believe that the whole room didn't stand up and clap on that.
I do think we at OSFI can be more mindful and responsive to the issue of proportionality. The transition we have to make is when you do think about proportionality, you do think about making it easier for smaller players to compete into a system with very large internationally active players. That means we have to assume and expect some additional risk tolerance, best way to put it. And I referred to it in my speech. And the way I'd like OSFI to continue to do it is to be proactive. So mindful of this, last year we went out to smaller and medium-sized banks through the Canadian Bankers Association and said, give us your best ideas on capital that might address the proportionality issue. They came back with a bunch of ideas, and we said, yeah, on these ones, okay, yes. And then you'll see that in more detail in November when we finalize the work with the SMEs. So now, our SME regulated constituents responded really well, and I think it was important that we made the first move, that we went out and said, we want to talk about this. And we were comfortable, and we weren't perfectly comfortable, but we were a little bit comfortable because we had the resilience I just spoken of. And I think that has to be an annual thing at OSFI. So removing some of the guidelines and advisories that we did last year, we're going to do that again this year. That's not 1 or 2 years and done. Every year we should be looking at, okay, where are the guidelines and advisories where the risks don't really warrant it, or whether they've been trumped by other guidelines. For every new guideline we bring in, we should be thinking about is there some regulatory expectation we can lighten? And that would be driven primarily by an eye towards proportionality.
So you expect to be applauded for removing guidelines, but when you remove things, some people want to know why. So I'm going to ask you one of those questions. Right. OSFI has stated an intention to phase out the mortgage MQR. However, the industry sees the MQR as a valuable tool that ensured resilience through a period of sharply increasing rates starting in March 22. Why would you phase out an important tool?
Good question. I would respectfully disagree with the premise. So let me explain that. As we went through the COVID cycle, we did see, I think it's fair to say, a boom in household lending. Annualized originations went from about $270 billion per year to $440 billion per year. During that $170 billion difference, by our estimate, about 160 of that $170 billion increase was in the form of variable rate mortgages. And a majority of those mortgages happen to be variable rate with fixed payments, which add the risk of negative amortization and substantial payment reset rates. So, okay, the MQR was in place there. That was a risk concentration, all things equal, I would have preferred to avoid. And the MQR didn't catch it, that's just fact. So we've experimented and stole an idea from the Bank of England. And in 2014, the Bank of England put in place something called a loan-to-income test. And that is a test applied to a financial institution, not an individual mortgage. So the MQR, every mortgage has to be stress tested at a particular rate. With a loan-to-income test, it's a portfolio level test. It says you can't give more than X% of mortgages out to borrowers with loan-to-income ratios higher than 450%. And in the UK case, that worked as the binding constraint in mortgage underwriting. So much so that they dropped their own mortgage stress tests. So we said, let's experiment with the LTI and see what it does. When we started that test, we communicated, and this is where I'm disagreeing with the premise of the question, we communicated that the LTI could either be a complement or a replacement for the MQR. And so what we will do, after we've done a year, we're about 2/3 of the way through our pilot of the LTI. What we'll do starting in 2026, we'll have a full year's worth of data, and we will consult with the industry on a variety of credit risk management issues, including B20, which will include a look at the MQR. And it's quite plausible we keep both, and it's quite plausible we do something other than that. And what we need is consultation with the industry before we come to any conclusions.
Great, thank you. Mortgages. Can't have a discussion without talking about mortgages. How are you feeling about the mortgage sector right now, given where we are in the cycle on renewals and the headwinds just generally, given the macro environment?
So here I'm going to compliment the MQR, believe it or not. So notwithstanding the issues I mentioned, like one thing we've noticed in this cycle is as the economy has slowed, as unemployment started to, employment leveled off, and now we saw a negative print on unemployment last month. So as that's happened, mortgage delinquencies have bounced off all-time lows to near all-time lows. The last time I looked, mortgage delinquencies were about 0.25%. The worst we've seen nationally is about 1% in the last 30 years. Mm-hmm. So on balance, pretty good. What's the explanation for that? Well, part of it is an MQR was applied to every borrower, and they're adapting to this higher rate. So on balance, in aggregate, I look favorably at the performance to date. Now, we're going through a pretty significant economic shift, and different parts of the country will experience that shift differently, and that's just reality. It's unfortunate, but it's reality. And we may see more variance and higher mortgage delinquencies in certain parts of the country, the parts of the country that are more affected by the trade tensions that exist between Canada and the United States. There is some evidence of it, but here again, the evidence is in the category of gradual deterioration as opposed to step change. And so if that trend continues, we will see more, unfortunately, likely more mortgage delinquencies. But the system will absorb that in a way that doesn't really harm fundamental financial sector resilience.
Right.
And I'm not saying mortgage delinquencies are okay. They represent a real crisis for a real family, and when it goes up, that's not a good thing. But if you're asking me, in my role as superintendent, is the system going to absorb it relatively handily? The answer I'd say is, from what I see now, yes.
Yep, great. We had a session earlier today on private markets and on the significant growth in private markets and sort of the growth coming in the retail segment increasingly, as opposed to really being an institutional vehicle. As you know, the PRA in the UK started to ask for data from their banks in terms of exposure. What's your view on the private market segment in general and any risks that you think that might pose? And do you think that, like, are you now thinking about how you might incorporate that into your process?
It's a new business model outside our regulatory perimeter. It's not our job to expand our regulatory perimeter to try and regulate that. So, we stay within our bounds. The work at the PRA also came out of the work that came from the FSB, and we will take those good ideas, and I'll talk about that in a minute. If I think about how that sector might affect the institutions we regulate, it would be through counterparty risk. And I think when you think about counterparty risk, because that sector is new and some of the institutions are private by their very nature and a little bit more opaque than, say, a company that's putting out thousands of pages every quarter on their financial condition, we need to make sure that counterparty risk is well governed by the institutions we regulate. The Financial Stability Board has put together a list of recommendations for what counterparties should be looking for when they transact with these non-bank financial intermediaries. Standard metrics like leverage, like liquidity contingency plans, and like potential worst-case liquidity scenarios. If you're going to extend credit to an institution that is private and is a non-bank financial institution, a good lender would be doing that. The mortgage stress test is that. Can you handle an interest rate of 5.25% or 200 basis points a higher contract rate? That is the same thing as saying, well, can this private counterparty that this commercial capital market bank is working with or transacting with, can they handle a spike in interest rates? It's the same thing. It's just sound underwriting. And so I think that when we do work in the new year on credit risk management guidelines, we will be addressing that. And we'll be talking to the PRA and trying to learn whatever we can from them.
Terrific. Thank you. This is a good question. Is the view you've expressed on leveraging resiliency in the current economic context just an example of countercyclical capital management or indicative of a more permanent through-the-cycle revised posture?
I understand the question. I understand there's this distinction between what's permanent and what's cyclical. In our world, 2022, 2023, 2024, notwithstanding some of the issues outside Canada, economy was growing, credit was growing faster than nominal GDP. In that world, as a good supervisor who wants systemic resilience, wants to build additional buffers in the system, be it liquidity or capital. And then when the system starts to peak temporarily and then maybe come off a little, which in an economic cycle that happens, yeah, that is the time where that resilience you built up should be used. We don't think philosophically should we be permanent or should we be countercyclical. We're just looking into the future as best we can, and we're trying to determine, is now the time to be building resilience or leveraging it? And we're shifting. And with this conversation we're having and the speech I just gave, we are acknowledging that there is a shift in mindset that we need to make in order to fulfill our mandate.
Okay, thank you. AML. Something I think that we need to talk about as well. There's clearly, you've identified it as a prudential issue. There's the Federal Strong Borders Act. There's the Financial Action Task Force. How are you feeling about where we are on this subject? And is there changes coming in terms of how OSFI intends to supervise AML?
Yeah. So a lot of, I'm going to answer that in multiple parts. Like the first thing I mentioned, our Integrity and National Security Group, like one of the institutions they're plugging into on a more regular basis is FinTrack. And so, yeah, that is underway. In Bill C-2, there is a part of Bill C-2 that would place FINTRAC on the Financial Institution Supervisory Committee, or FISC, and within certain constraints for privacy, that will further open up the information flow between OSFI and FINTRAC so that we can detect AML issues earlier and respond more consequentially. And yes, that is an adaptation to this new world. And out of that closer alignment with FINTRAC, we will be supervising AML in a more, to be blunt, in a more intensive way. And that is a risk choice we've made on the basis of our experience. I'd argue we started it several years ago when we saw the change in our mandate, and we still have further to go. And if and when FINTRAC joins FISC, that'll be a constructive step forward.
Can you expand a little on a more intensive way?
In a more intensive way, and this, you understand, if folks here, I'm sure some folks like me have looked at what is in a suspicious transaction report. It's a lot of information, and some of it is actually quite private and protected by privacy laws. In processing that information, analysts can detect patterns. Those patterns can be based on product, or could be based on institution. There's some part of AML where those patterns get detected, and the anti-money laundering supervisor would inform law enforcement. We're not part of that. That is not OSFI's mandate. We don't want it to be OSFI's mandate. We're not there. Where the patterns of information uncover weakness at an institution, integrity and security weakness at an institution in defending themselves against money launderers, then provided we maintain our principles around national security information protection and privacy information protection, then we can act on it as supervisors. And that has occurred here with OSFI. And it can make a difference. And we have some ways to go to mature that effort. The one closing thing I'd say about money laundering is that money laundering, to be money laundering requires a predicate crime. And after the predicate crime has been committed and there is money to launder, institutions, financial institutions, become targets for these criminals. And what I've asked boards to do is to think about their institutions as strong, law-abiding institutions who need to protect themselves from bad actors who will attack them. That is how to think of money laundering.
So thank you very much. Maybe I'll wrap with one final question and just spend a moment on governance. Because we've talked a lot about governance this past year with OSFI and just with the industry in general. How are you feeling about, the board's capacity and capability generally today, given all of the complexity of what we've been talking about, throughout the day and many of the things you've commented on? Because the expectations of boards, I think, have changed dramatically over the last number of years, and in many ways, but not least in which is the expectations of the regulator.
Yeah. The thing that I won't say learned, I was a bank analyst, both the credit and the equity side, so I wouldn't say this surprised me, but what has struck me in this job is just how closely aligned the interests of shareholders and creditors and depositors are. There are extreme cases when you're very close to failure where the interests vary, but it is noticeable to me how tightly aligned the interests of shareholders and creditors are. So what I've learned is when we engage with boards, we're engaging with counterparties whose interests are near perfectly aligned. We want institutional stability in our system. Shareholders and creditors want that. And so we've come to redesign our supervisory process, build our corporate governance guideline around that central premise that the interests of board and OSFI are very aligned, and our job is to be better partners with boards so that they can do their job in being sound and important stewards of their organizations. And it is not, you know, not by conscious intent, but looking at it, we are establishing an intent, a non-confrontational, non-combative relationship with boards. We are partners. We have different stakeholders whose interests we are meant to represent, but those stakeholders' interests are very aligned, and it is collaboration and partnership should be the dominant mindset for OSFI as it approaches financial institutions. And I think what we've done on the supervisory renewal is help boards with that complexity. You know, when you're talking to a group of folks from OSFI who are supervising fairly large financial system, I think our assets under supervision are about $12 trillion. You know, we might have some useful insights to bring that protect individual institution information. But, you know, we might be actually constructive and have some good ideas for boards, and then they have to figure out how to implement them in their institutions. And then over time, I've generally found when we are constructive, the outcomes for both counterparties are pretty good.
Peter, thank you very much. Thank you for coming today. Thank you for coming for 5 years. Yeah. It's really important. And I really want to thank you for your openness and willingness to engage with industry. There was a lot of talk today, and you mentioned it in your comments, about the partnerships that take place. That doesn't happen without willing participants. And so you have been an extraordinarily willing participant. And I think what the group here doesn't know is before I do this with Peter every year, I say, is there anything I cannot ask you? Is there anything off the table? And I ask every year, and I get exactly the same answer every year, which is you can ask me anything. And so I think we are very privileged to have a regulator that is willing to come and sit in front of an audience, be recorded, be on the, it is just a reminder, be on all the vehicles that are out there, and allow us to ask anything we want. So, and respond as thoughtfully as you do, and take all the risk associated with that. So, Peter, thank you very much.
Good job.
Appreciate it.